The most significant financial shift of the decade is happening right now, and almost no one is talking about it. Imagine a vault, not just full of money, but full of history, power, and ultimate security. Now imagine the world's most powerful financial institutions, the central banks, quietly, systematically, and aggressively emptying the global market of its most precious asset. In 2023, for the second year in a row, central banks bought over 1,000 tons of gold. This isn't just a record, it's a financial earthquake. It's a clear, undeniable signal that the world's monetary order is fracturing, and the foundation it's being rebuilt on is not the US dollar. It's gold. Why are the guardians of global finance, the very institutions that manage fiat currencies, suddenly hoarding a relic of the past? The answer is simple: fear and foresight. Fear of geopolitical instability, fear of weaponized currencies, and the foresight to understand that the next era of global finance will be defined by assets that cannot be frozen, sanctioned, or devalued by a single government. This isn't a speculative trade, it's a strategic, existential move. It's the sound of the world's financial elite preparing for a future where trust in the established system is gone. And if they are preparing, shouldn't you be too? This is the story of the great gold rush of the 21st century, a deep dive into the geopolitical and economic forces that drove central banks to accumulate over 1,000 tons of gold in 2023, and what this means for your portfolio and the future of money. To truly grasp the magnitude of this move, we must first establish the context. For decades, the US dollar has reigned supreme as the world's primary reserve currency. This status, often called the exorbitant privilege, allowed the US to finance its deficits cheaply and exert unparalleled global influence. But this privilege came with a hidden cost. The dollar became a weapon. The freezing of Russia's foreign exchange reserves following the invasion of Ukraine was the shot heard around the financial world. It demonstrated that holding reserves in a foreign currency, particularly the dollar, was no longer a guarantee of security. It was a liability. The 2023 gold buying spree is a direct, calculated response to this realization. It's a diversification strategy driven not by yield, but by security. Gold, unlike fiat currency held in a foreign bank, is a physical asset that cannot be digitized, frozen, or subjected to the whims of a foreign government's sanctions policy. It is the ultimate form of monetary sovereignty. Let's look at the numbers. The World Gold Council reported that central banks purchased a net 1,037 tons of gold in 2023, following a record 1,082 tons in 2022. This two-year accumulation is unprecedented in the modern era. Who were the biggest buyers? The list is telling. The People's Bank of China was the largest reported buyer, adding a staggering amount to its reserves. But it wasn't just China. Countries like Turkey, Poland, Singapore, and India were also major players. This is not a regional phenomenon, it is a global, coordinated pivot. The motivations of these buyers are complex, but they converge on a single point: risk mitigation. For China, the motivation is clearly tied to its long-term strategy of reducing reliance on the US dollar. The PBOC has been steadily increasing its gold holdings for years, a move that aligns with its ambition to internationalize the yuan and challenge the dollar's hegemony. Gold provides a neutral, universally accepted asset to back this transition. For countries like Turkey and Poland, the buying is often a response to domestic economic instability and high inflation. Gold acts as a traditional hedge against the devaluation of their own currencies. By increasing their gold reserves, these central banks are signaling to their markets and citizens that they are building a solid, tangible foundation for their monetary system. It's a move to restore confidence. But the most compelling reason, the one that ties all these purchases together, is the accelerating trend of de-dollarization. The US dollar's dominance is being eroded by a combination of factors: the massive increase in US national debt, the use of sanctions, and the rise of alternative economic blocs like BRICS. Central banks are not waiting for the dollar to collapse. They are proactively building a financial firewall. They are shifting from a system where their reserves are another country's liability to a system where their reserves are a universally accepted, unencumbered asset. The sheer volume of buying, over 1.0 tons, has had a profound impact on the global gold market. Central bank demand has become a powerful, consistent price backstop. Even when traditional investment demand from Western markets might waver due to high interest rates or a strong dollar, the relentless buying from the official sector keeps the floor under the gold price. This structural demand shift is one of the key reasons why gold has maintained its strength, even in a challenging macroeconomic environment. The implications of this trend are far-reaching. Firstly, it signals a move towards a multipolar monetary system. The world is moving away from a single dominant reserve currency. Gold is emerging as the neutral arbiter in this new system, a common denominator that transcends geopolitical rivalries. Secondly, it validates gold's role as a strategic asset. For years, gold was dismissed by some as a barbarous relic. Central banks, the most sophisticated financial players in the world, are now emphatically proving that assessment wrong. They view gold not as an investment for yield, but as a strategic reserve for survival. The question for the individual investor is, if the central banks, with all their data and foresight, are aggressively buying gold, what should you be doing? The answer is not necessarily to blindly follow their lead, but to understand the underlying forces driving their decisions. The risks they are mitigating, geopolitical instability, currency debasement, and systemic financial risk, are the same risks that threaten your wealth. The central bank gold rush of 2023 is more than a financial footnote. It is a historical marker. It signifies the end of an era of unchallenged dollar dominance and the beginning of a new, more volatile and multi-asset-based financial world. Gold is not just a hedge, it is a foundational asset for the future of money. Detailed expansion on geopolitical drivers and sanctions. The catalyst for the current gold buying frenzy can be traced directly to the weaponization of the US dollar. The freezing of approximately $300 billion in Russian foreign exchange reserves in 2022 sent a clear, chilling message to every nation on Earth. Your reserves are only safe as long as you remain in the good graces of the United States and its allies. This single event fundamentally altered the risk calculus for central bank reserve management globally. For non-aligned nations, and particularly those with strained relations with the West, the need for a non-sanctionable asset became paramount. Gold fits this requirement perfectly. It is physical, it is fungible, and its ownership is decentralized. A ton of gold held in a vault in Shanghai or Mumbai cannot be electronically frozen by a decree from Washington or Brussels. This is the core of the monetary sovereignty argument. Central banks are prioritizing the security and accessibility of their reserves over the marginal yield offered by US treasuries. Consider the case of China. While the PBOC has been a consistent buyer, the pace accelerated significantly after 2022. This is a strategic move to build a war chest of neutral assets. In a scenario of escalating trade or geopolitical tensions, a large gold reserve provides a crucial buffer and a foundation for international trade outside the dollar system. It's a quiet but powerful declaration of financial independence. The BRICS nations are actively exploring mechanisms for trade settlement in local currencies, often backed by the implicit stability of gold. While a formal BRICS gold-backed currency remains a distant prospect, the collective accumulation of gold by these nations is a tangible step towards creating a financial architecture that bypasses the Western-dominated SWIFT and dollar systems. The 1.00 ton figure is not just a number. It is the physical manifestation of this geopolitical realignment. Detailed expansion on de-dollarization and reserve diversification. The dollar's share of global foreign exchange reserves has been in a slow, steady decline for years, but the central bank gold buying spree is accelerating this trend. Central banks are not just swapping dollars for gold, they are diversifying their entire reserve portfolio. This includes increasing holdings of other major currencies, but the most significant shift is towards gold. Why the urgency now? The unprecedented fiscal and monetary expansion in the US and Europe over the past decade, particularly during the pandemic, has raised serious concerns about the long-term stability and purchasing power of fiat currencies. Central banks, as long-term stewards of national wealth, are acutely aware of the inflation risk inherent in endless money printing. Gold, with its historical track record as an inflation hedge, offers a reliable countermeasure. Furthermore, the sheer size of the U.S. national debt, now exceeding $34 trillion, introduces systemic risk. While U.S. treasuries are traditionally considered the safest asset, the political brinkmanship over the debt ceiling and the long-term fiscal trajectory of the U.S. government are eroding that perception. Central banks are essentially saying, we still need safe assets, but we are no longer comfortable putting all our eggs in the U.S. Treasury basket. Gold is the ultimate no-counterparty risk asset. It is not a promise to pay, it is payment itself. The buying is also self-reinforcing. As more central banks buy gold, it validates the asset's role and encourages others to follow suit. This herd mentality, driven by strategic necessity rather than speculative greed, creates a structural demand floor that is unlikely to disappear anytime soon. The 2023 purchases confirm that this is not a temporary spike. It is a new, higher baseline for central bank gold demand. Detailed expansion on historical context and gold's role. To understand the current moment, we must look back. The last time central banks were such aggressive net buyers was before the collapse of the Bretton Woods system in 1971. For much of the 20th century, gold was the anchor of the global financial system. The shift to a purely fiat system, unbacked by any physical commodity, was an experiment. The current gold rush suggests that the world's financial architects are having second thoughts about the long-term viability of that experiment. Gold serves three critical functions for a central bank. 1. Sovereignty. It is an asset that represents national wealth and independence, free from the control of foreign powers. 2. Crisis hedge. In times of extreme financial stress, gold is the asset of last resort. It is universally accepted and retains value when other assets, including currencies and bonds, are collapsing. 3. Confidence. A large gold reserve signals stability and prudence to both domestic and international markets. It is a tangible symbol of a nation's financial strength. The 2023 buying spree is a return to first principles. It is a recognition that in a world defined by digital assets, interconnected financial systems, and weaponized currencies, the oldest form of money is the most reliable. The central banks are not buying gold to make a profit. They are buying it to ensure their survival and the stability of their nation's financial systems in an increasingly unpredictable world. Case studies, key buyers in 2023. China, the undisputed leader. Their buying is strategic, long-term, and aimed at reducing dollar exposure. The PBOC often reports its purchases with a delay, suggesting the true accumulation might be even higher. Their goal is to build a reserve base commensurate with their status as a global economic superpower. Poland, a clear example of a central bank reacting to geopolitical risk. Located on the edge of the conflict in Ukraine, Poland's central bank explicitly stated its intention to increase gold reserves to protect the nation's financial stability against external shocks. Their buying is a direct response to the heightened security environment in Europe. Singapore, a major financial hub, Singapore's buying is driven by a need for reserve diversification and a hedge against global financial volatility. As a small, open economy, Singapore is highly exposed to global shocks, making gold a crucial buffer. India. India's buying is often tied to its massive domestic gold market and its need to manage its balance of payments. However, the recent acceleration also reflects a strategic move to diversify reserves and enhance financial stability. The collective action of these diverse nations, from geopolitical rivals to regional powers, underscores the universal appeal of gold in the current climate. It is a consensus asset for risk mitigation. The impact on the gold price and future outlook. The central bank buying has fundamentally altered the supply-demand dynamics of the gold market. The official sector now accounts for a significant portion of annual gold demand, creating a structural support level that did not exist a decade ago. This consistent, price-insensitive demand acts as a powerful stabilizing force. For the gold price, this means that even if traditional Western investment demand slows down, the central bank bid provides a floor. This structural demand is a key reason why many analysts are bullish on gold's long-term prospects. The central banks are signaling that they believe the risks to the global financial system are rising, and they are willing to pay current prices to secure their reserves. Looking ahead, the trend is unlikely to reverse. Geopolitical tensions are not dissipating, and the long-term fiscal challenges of major reserve currency issuers remain. As long as the US dollar remains a potential tool of foreign policy, and as long as global debt levels continue to rise, central banks will continue to prioritize gold. The 1,000 ton mark is no longer a ceiling, it is the new normal. This shift is a profound lesson for every investor. The institutions that manage the world's money are telling you, through their actions, that the old rules of finance are breaking down. They are moving towards tangible, unencumbered assets. Your portfolio should reflect this new reality. Gold is not just a hedge against inflation, it is insurance against systemic risk and the ultimate expression of financial independence.